Okay, it is 11 o'clock, so we can get going, I think. I've got a bit of news to cover. So, three things I pulled out this week, Apax, Third Point, and Seraphim. There is a couple of things we could have talked about, but I think these three will do. Apax first. Private equity fund actually had quite a good run of performance for quite a long period of time, as you can see there. That came off the boil in end of 2021, beginning of 2022, which, as we know, that's the signal for the change in inflation and interest rates. That's a common thing for a lot of other funds. Apax has got quite a tech-heavy portfolio, and that's affected valuations and also exit opportunities. It's over £1 billion portfolio. It's invested in sort of traditional kind of private equity, so it's invested in funds and then into underlying companies. It's targeting funds at sort of upper mid-market, so not the really big deals, but sort of the next tier down. And then in those sectors of technology, services, and internet consumer type stuff, which just gives it that kind of growthy bias, which means that it's been hit by interest rates. Now, discount was obviously way too wide. A lot of people were getting a bit upset about this, and something needs to happen toward the board. So we now have a bid by something called Janus Bidco, which has nothing to do with Janus Henderson. And it's a choice of cash or rollover into a new vehicle. The new vehicle is quite complicated. We're going to talk about this and how it all works, but basically it's unlisted. The equity side of it is backed by Ares Management. So effectively they're injecting cash into that, which will be then used to buy out Apax shareholders. But the fund will carry on being advised by Apax partners. So it's basically, from their point of view, no real change from running Apax Global Alpha or running this new fund. There's also going to be debt finance in there as well, to help get the whole thing done, plus whatever rolls over from the existing fund. So they've got a fair bit of support for what the proposal is already. That doesn't mean it's a done deal, but it does seem to be as unlikely that anybody will come in and try and intervene in this. Quite a lot of the share register is made up of Apax employees, and so I would think they're probably all on side. But the interesting thing, I think, is that the board is going for the cash option across the board. So the whole directors are going for the cash option. So in terms of where that came in, obviously it's quite a big premium to the last closing price. That price had clearly been coming in ahead of the deal. I don't want to say there's anything suspicious going on there, but it's coincident. Because it's a massive premium to the 1 month average price, 30%. Where people have put a question mark on this is that it's a 17% discount to the NAV, and that's an up-to-date NAV as at the end of June. So that's pretty chunky, and I can understand why people might be not entirely happy with that. But I think the counter to that would be, well, if you really like it and you believe in the asset value, you can actually just continue to hold the assets through the new vehicle. So the rollover option, fortunately, is not restricted to professional investors. So retail investors can invest in it. The only wrinkle is you can't be in what we call a restricted jurisdiction, which is probably going to be stuff like the US. And you're going to also have to pass the know your client and anti-money laundering checks that the fund's got to do to make sure that you're okay, which is going to be in a whole bunch of paperwork. The other wrinkle I haven't put on there, it's going to totally depend on your platform, whether your platform allows you to do it. So that's going to be an issue for some people, I would think. If you want to go down the rollover option, you've got to roll over at least half your stake. That's as a minimum to qualify for this. But if everybody said, yeah, okay, I want to roll over, there'd be a problem because the whole thing is capped at 40% of Apax equity. I don't think it's going to be hit anyway, but if it was, then that would be scaled back. Now, what you end up with is a geared exposure to the same portfolio that you had before because of this debt. So there's a whole bunch of term loans in there, plus a revolving credit facility. But because it's like an equity slice with debt underneath it, and they're injecting 24 million euros of funding to cover management fees and all sorts of other things into that, you will be diluted by 3.9%. So the end of is you end up with sort of an exposure to the portfolio which is about equivalent to about having 50% gearing. That's kind of thing what they're saying. Now, once you're in the rollover vehicle, you can't really get out again unless the board lets you. So you can't transfer your shares to anybody else. There's no secondary market in these things. Bear in mind, the board is not independent. The only person who's got the right to appoint board members are the holders of the one class of shares, which is just Apax. So basically, they're completely in charge of this thing. You don't really have any voting rights. To the extent that your class that you're in does have a vote on things, Aries will dominate the whole class, so they'll be deciding what happens. So minority investors can't really moan about that. There'll be no meetings. There's no way of influencing the board to do anything. So once you're in, and all the protections you have as part of a listed vehicle are gone. And part of those protections currently would be to stop you being diluted if they issue new shares. It does warn in the document that it's possible, not definite, but it's possible that they could raise money that could be dilutive. Or they could do a thing where they say, we want everybody to stump up more cash. If you don't stump up cash, you're going to be diluted and there's no protection. So there is one way out, in that there's going to be this voluntary redemption opportunity, but it doesn't let you out of the whole thing. So 90 days ahead of 30th of June each year from 2027, you'll be able to say, I want to take out 10% of my stake. And the first time you do that, that'll be a 10% discount. And then that discount reduces until it gets down to zero in 2031. There's a possibility that the new board will up that 10% limit, but no guarantee. And obviously, looking at that, there's no way out. I don't think, this doesn't say in the document that it will happen in 2032. So it might not happen. The alternative is that at any time in the first 2 years, in 6-month intervals, that is, you can elect to be in runoff shares. So basically, it's like being in a managed wind down. So if you like the portfolio, if you're not too worried about this loss of minority shareholder rights, if you're not afraid of being diluted, you go for the runoff class. But once you've said, I want to be in runoff shares, you can't change your mind again. So in terms of the rest of the sector, there's been a few headlines saying that made share prices jump, and you can see that in the 1 month share price returns there, so Pantheon and Harbourvest, and also for NB Private Equity. So you did get a bit of an uplift in CT Private Equity 2, ICG Enterprise, although they did do another deal, which is helpful to their share price as well. So I'm not sure, though, that really makes sense, because this is a very strange situation because of the Apax relationship with all the partners being involved in it. I'm not sure that this deal is going to be replicated elsewhere. It seems to me to be unlikely. Having said that, we still have the possibility that somebody comes and does an Electra, which is something I bang on about constantly and people probably almost forgotten about now. But there you had a perfectly good private equity trust that somebody came in and took over the management of, went into wind down, gave themselves massive bonuses for returning cash, and made a lot of money because, as I keep saying, all of these NAVs are very conservatively valued, and there's almost guaranteed upside as and when they exit things. Not on every deal, but across the piece, they've got a very good, consistent track record of selling stuff at a premium to the NAV. So if you just wind the thing up, you should get a higher valuation than you've got at the moment. And lastly, I just grabbed this off their website. And this is the point. This is the thing we keep banging on about. The whole point of listed private equity, and the reason why we're so frustrated with these discounts, is that they give you access to an asset class that you can't get any other way. So Apax boasted that it was focused, tradable, and accessible, and private equity made simple. This new thing is none of those. The only thing it is focused. I really, from the point of view of is this the way we want the sector to go? Definitely not. So third-party investors. Next one. There's an odd spike in that chart, which I think Morningstar getting the NAV wrong. But if you ignore that, you can see that NAV sort of trended upwards. The share price sort of following the same thing, but the discount's been consistently wide. Again, shareholders are quite frustrated by this. Maybe not as big as the manager would have liked either. And so they came up with this witty idea to become an insurance company. And we talked about this on the show on the 23rd of May. So if you want to find out more about that deal, you can go back and watch that again. There was a lot of pushback on the back of this, and we said at the time we weren't happy with it. Basically, it only let investors get out of $75 million worth of shares, which is about 13% of the company currently. They said, okay, well, we've listened to you. We've upped that to $136 million, but that's still only 23.76% of NAV. And I think an awful lot more than that of people don't want to roll over from a hedge fund into an insurance company. If you want to get out, you were being forced to get out at 12.5% discount. They've now narrowed that into 4.8. Isn't that great? No, it's not. It's still not an exit at NAV. And that's where I think basically people should be offered a full exit at NAV for anything they don't want. And if being an insurance company is a really great idea, Third Point should be able to go and raise money from new investors to back that idea. What they're doing is trapping people in here. But they say they've got irrevocables in support of this covering 45% of the voting rights. So when I first read this the other day, I wrote a comment and basically said, well, that looks like a done deal then. But turns out that a big group of minority investors have got together, formed a sort of action group, and they are going to fight in the minority investors' corner for what we say like a full exit at NAV. They say that proposal that Third Point is putting forward, because of the radical nature of the change, should need the support of independent shareholders. And if you take out the Third Point investor and the manager shares in this, then the irrevocable thing is that it's an awful lot lower. They say it's an attempt to trap shareholders in a risky startup in a competitive market, which I completely agree with. And they're going to be talking to regulators and the board and other shareholders ahead of the EGM. So basically, they're saying, if you're an investor in this, we want you to back us. If we kick up a big enough fuss, we think we can block it. And I agree with what they're doing. Even if you think being an insurance company is a great idea, from a corporate governance point of view, this is just a step too far. So a good news story to finish up with. So Seraphim Space then. Obviously, it's not that old yet. The NAV's been fairly flat. There's been winners and losers along the way. The discount spiked out along with everything else, especially because it's a kind of growth capital stock. And in periods of higher interest rates, people are less keen to take on risky things, much less keen to take on things that burn cash and might need to fundraise in the future. So that affects valuations across the piece, and that's one of the reasons why discount is wide. But it is narrowing now. This is the portfolio as at the end of March, and you can see that within this, the NAV being fairly flat, as I say, there's been a lot of move within that. One company, ISI, has ended up being 25% of the portfolio, and it's been steadily written up, as I'll show you in a second. There are good reasons why it's been written up. So these are all the things that it's announced this year. So they've done a deal with Saab for satellite stuff. They did a deal with a cooperation agreement with NATO. They did a €200 million deal with the Polish government. They did a joint venture with Rheinmetall, which is the stock that's gone to the moon on the back of all this defence spending in Europe. They've done a deal for satellites with a big Japanese company. All of these things, boom, 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 all the good news, and they support the valuation at the end of March. But then, 21st of July, the FT had a story that Poland, in addition to doing this deal for satellites, is saying we'll actually want to put an equity stake in the business. And the story basically implied that it's going to be a significant premium to the current valuation and significantly higher than $1 billion. So this has been a great success for Seraphim Space. You can see how it's been written up. Bought for 39.6 million and currently valued at 61.1. I have no idea what that valuation is going to be. I tried very hard to work out where the values were before, but it's all quite opaque. It's natural with these private companies; they don't really tend to give you that game away. But given that it's 25% of the portfolio, if it's a big uplift, that's going to make a material difference to the NAV. So just one thing to bear in mind. Cool. That's enough from me.